Good evening, everyone. I'm 𝗍𝗃 from FSMOne. So welcome to this evening webinar, FSM MAPS, recap of our first quarter 2024 performance and the preview of what lies ahead. So the global economy seems to be on the road to recovery, with both Nikkei 225 and S&P 500 on the upward run. So the question is, what's next for the markets then? So which direction will it take in the second quarter of 2024 then? So this evening, I'm privileged to have 𝗪𝘃𝗀𝗁, Portfolio Manager of Research Team iFAST Singapore, who will, over the course of tonight, walk us through the first quarter of 2024 and share with us what we can expect for the next few quarters. So if you have any questions along the way, feel free to put them in the Q&A box, and then 𝗪𝘃𝗀𝗁 will get to them at the end of his presentation. So without further ado, let me pass over to 𝗪𝘃𝗀𝗁 to start the webinar going. 𝗪𝘃𝗀𝗁, please.
All right. Okay, very good evening to everyone, and again, welcome to tonight's webinar. So my name is 𝗪𝘃𝗀𝗁, and I'm from the research team. And in tonight's webinar, I will be sharing some of the latest updates to our FSMOne MAPS portfolios, the changes that we are planning to make, as well as some of the key happenings in markets and how that affects our positioning. So without further ado, let's first start with a recap of markets so all of you can get a better sense of where we are. So global equities, they have had a fantastic start to the year, with the MSCI AC World Index up by about 11% by the end of the first quarter. So all equity markets delivered positive returns, led by double-digit gains from developed markets such as the US and Japan. So as you can see from the table, semiconductor stocks also did incredibly well, rising by about 31% year to date. So US equities, they rose by 13.2%, with the S&P 500 index reaching a new record high of around 5,200 points near the end of March. So the gains, they were predominantly driven by the tech sector, but there was also evidence that the rally has been broadening out to other areas as well. So the US economy, it continues to demonstrate its resilience even in the face of high interest rates. So in the third estimate of fourth quarter GDP last year, the US economy grew much faster than expected by about 3.4% for the quarter, beating estimates of a 3.2% gain. So this follows a 4.9% gain in the third quarter of 2023. So growth in the fourth quarter, it was mainly driven by increases in consumer spending during the holiday season. So if you look at the Consumer Confidence Index, which is the one measured by the University of Michigan, it has also reached its highest level since mid-2021. And if you look at the labor market data, it shows that the US labor markets in the US remain tight, with the US adding more than 300,000 jobs in the month of March, which is way above the consensus forecast for a gain of about 212,000 jobs. Next, we look at Asian markets. So in Japan, the Nikkei 225 returned 15.6%, and the index also breached the 40,000 point mark earlier in March. So the big news for Japan, it has to be the Bank of Japan's monumental decision to close the chapter on its negative interest rate policy. So we've been following up with the news. In the month of March, the BOJ actually raised interest rates from negative 0.1% to between 0 and 0.1%. And BOJ officials has also said that it will put an end to its yield curve control policy and also discontinue the purchase of ETFs and REITs. So stronger economic growth, corporate earnings, and inflation returning to Japan, and also rising wages, they are some of the key reasons for the policy pivot. And foreign investors, they also remain net buyers of Japanese equities over the first quarter. So more on Japan later. Now, over in Europe, the Stoxx 600 index rose by 7.7% year to date, with the tech sector leading the charge. And amid ongoing optimism over demand from AI-related technologies, companies like ASML rose by 31%, and it contributed to about 12% of the index return. And other top gaining sectors include financials, consumer discretionary, healthcare. And unlike the US, inflation in the Eurozone, it continues to make steady progress towards the central bank's 2% target, which gives the ECB more room to maneuver monetary policy. So the Eurozone Composite PMI was also revised up to 50.3 in March, which indicates a return to growth for the Eurozone's private sector for the first time since May of last year. And moving on to China, so despite the late rally in Chinese equities, they have only risen by 0.1% year to date, as investors remain cautious amid ongoing fears about the outlook of the Chinese economy. And on the flip side, other Asian markets such as Taiwan and South Korea continue to see gains as global trade and semiconductor demand improves, as I think many of you know that these two markets, they are heavily exposed to the semiconductor industry. And lastly, for the sectors that we have inside our portfolios, namely your digital economy and semiconductor stocks, they continue to lead the charge as investors continue to buy into the AI growth story. So as you can see from the table over here, both sectors, they saw rather good gains with share prices rising by 13.5% for the digital economy. And for semiconductors, it was even larger at close to 32%. Now, moving on to fixed income. So bonds didn't have such a good quarter as equities. So global bonds, they actually fell by 2.1% year to date, as the 10-year Treasury yield rose from roughly 3.9% at the beginning of the year to about 4.2% as of the end of March. So riskier credit segments such as your emerging market hard currency bonds, your US high yield bonds, and even Asian high yield, they outperform, and that is mainly due to their lower duration profile and credit spread compression. And the first quarter of the year also saw a significant shift in the landscape of inflation and interest rate expectations. So even though the Fed maintained its expectation for 3 rate cuts this year, as they have said in their summary of economic projections that was published after the March meeting, markets, they have actually drastically reduced the number of expected cuts this year from 6 rate cuts at the beginning of the year to just 3, as global economic activity remains robust. So hotter than expected US inflation data, strong labor markets, like I mentioned earlier, has dampened investors' sentiment about early rate cuts, and that also drove a repricing in yields. So moving on to portfolio performance. So in terms of performance for our growth portfolios, we delivered gains across all our portfolios ranging between 2.55% to 7.1% across the first quarter of the year. So year-to-date returns, they're the same because it's first quarter. So the more conservative portfolios, they managed to outperform their benchmark, and that is mainly due to our short duration overweight. So all our short duration bond funds, they actually beat the global bond benchmark. And on that note, as a matter of fact, all of our fixed income funds, they have actually managed to deliver positive returns over the quarter. And also neutralizing our equity versus fixed income allocation in January's rebalancing also contributed to returns, given that equities have outperformed fixed income over the quarter. And within equities, our US fund picks, particularly the growth-oriented funds, they contributed positively to returns. And also our decision to take a larger position in your digital economy, it continues to pay off as tech stocks, they have been on fire this year. Now for the negatives, so the main detractors of portfolio returns are the culprits are your Asia ex-Japan funds, which have delivered below benchmark returns, and that is largely due to underwhelming returns out of Chinese equities. And moving on quickly to our income portfolios, so things are more or less the same. They delivered returns of between 2.3% to about 5.7%. Now, in terms of individual fund performance, so broadly speaking, growth has outperformed value over the quarter. And if you look at this table over here, you can see that most of our growth-oriented funds, they managed to deliver significantly better returns versus their value-oriented counterparts for markets such as US, Europe, and Japan. And again, this is largely due to improving investor sentiment as the soft landing case builds, and also for the reasons that I have mentioned earlier. And for the top performing fund of the quarter, it goes to none other than the VanEck Semiconductor ETF, which delivered more than 31% returns over the quarter. Now moving on to the performance of our emerging market equity funds. So as mentioned earlier, our Asia ex-Japan funds are one of the reasons why our portfolio returns were lower than the benchmark for the more aggressive portfolios. As you can see, they delivered returns of between 1.1% to about 4.6% over the quarter. And high exposure to Chinese equities, especially for funds such as your Schroder Asian Growth and your 𝗣𝗯𝘰, has not worked well for both funds for the past few quarters. And going forward, we are planning to make some changes to our asset allocation, which I will share more details about later on. Now, moving on, in terms of our tactical ideas, the BlackRock World Financials Fund delivered returns of more than 14% as large US banks, they continue to deliver on strong earnings on the back of higher interest revenue, and that is largely fueled by elevated interest rates. So US banks, especially the larger ones, they are also well positioned to absorb credit losses given their stronger balance sheets. And I think that also adds to investors' confidence on them. And moving on, the JP Morgan Global Natural Resources Fund, it has also done well with a significant portion of its portfolio being exposed to oil and gas stocks. And because of that, the fund has also benefited from rising oil prices. Moving on to our fixed income funds. So as you can see from this table over here, all our funds actually outperformed the global bond benchmark. And the largest gains actually came out of the Asian high yield and emerging market bond funds, which saw strong returns that is mainly due to credit spread compression. And on a note for Asian high yield, I think over the past quarter, you have seen the Chinese government always coming out to express more support for not just the economy, but also for the property sector. And I think that also stimulated some positive investor sentiment within the space. Now, moving on to portfolio actions. So I've not included all the portfolio actions, but rather the more important ones. So over the past couple of months, we did 2 rebalancings. The first one, the earlier one was back in September of 2023, where we made some adjustments to our portfolio, namely to the digital economy segment and also to underweight China. And since our last rebalancing in January, we have not made any changes to our portfolios yet. So the last time we did rebalancing in January, we implemented 3 changes, as you can see in the table over here. So the first is to raise our equity allocation from underweight to neutral. That is by 2.5% across all our portfolios. And the second is to equal weight our value and growth allocations for the equity sleeve. And the third is to raise our emerging market bond exposure from underweight to neutral in exchange for a further underweight in Asian high yield bonds. And I think all of these changes have so far worked out well for us. Equities have outperformed fixed income. Emerging market bonds have delivered positive returns of 1.3% versus the global bond benchmark loss of around 2.1%. And growth has outperformed value. So at this juncture, we are quite comfortable with our positioning and thus have not made any changes yet. And again, we will likely be making some changes to our asset allocation and also our weighting methodology, which I will share again once they are finalized. Now, moving on, because we haven't made any changes, our inter-asset allocation, as well as our equity and fixed income intra-asset allocation remains unchanged. So on this slide, you can see our inter-asset allocation. It is basically at their neutral allocation. And on this slide over here, just to reiterate, for our equity intra-asset allocation, we are overweight on markets like Japan, neutral on the US, Asia ex-Japan, and Latin America, while being underweight on China and Europe. And as for fixed income, we are overweight global bonds and short duration bonds, neutral on Asian investment grade bonds and emerging market bonds. And last but not least, we are underweight the riskier segments of the market, namely your global high yield as well as your Asian high yield bonds. Yep, so like I said, since there are no changes to the allocations over the past quarter, the individual fund allocations for both the income as well as the growth portfolio, they are the same. Now, moving on, I'd like to share a few key market developments and how that actually feeds into our portfolio positioning. And let's start with Japan. So back in March, the Bank of Japan, they made the decision to raise its interest rates from negative 0.1 to 0 and 0.1. And yeah, it's the last developed market to exit its negative interest rate policy. So officials have also mentioned that they are going to eventually put an end to their asset purchases. While the Bank of Japan anticipates that accommodative financial conditions will be maintained for the time being, I think with these measures, it no doubt marks a shift away from the ultra-loose monetary policy that the BOJ has adopted over the years. And according to a statement made by the BOJ, the decision to make these changes was made after officials, they ascertained that Japan's economy has seen a moderate recovery and is likely to continue growing at a healthy pace. So just a while ago, fourth quarter GDP growth was revised up to positive 0.4% versus an initial estimate of a 0.4% contraction. And this increase was actually supported by positive contributions from exports and business spending as corporate profits improved. And despite this adjustment in monetary policy, our outlook for Japan to enter an era of structural transformation and consequently for Japanese equities to perform well has not changed. And as a matter of fact, the policy pivot by the BOJ, it only serves to reinforce our view that after a 25-year battle with deflation, inflation has finally returned to Japan for good, and that is a good thing. And as of March of this year, Japan's CPI came in at 2.7%, and it has also managed to stay above the central bank's unofficial target of 2% for the past 24 months in a row now. And on top of that, you can see that inflation expectations, they are also on the rise. So of course, one of the key factors behind this resurgence in inflation is that over the past 30 years is that Japan has a very positive wage growth in 2024. So as you can see from the chart on the right, wages actually grew by about 5.4% this year, which eclipses last year's gain of 3.6%. And I think as a matter of fact, if you look throughout the past few years, 3.6% is actually considered good by historical standards already. And as noted by the Bank of Japan, Japan's labor market is showing little signs of loosening, which makes it highly likely that wages will continue to rise steadily this year. And such huge wage increments, they are expected to provide a boost to consumption, supporting modest growth for both the broader economy. And in addition to enjoying heightened demand from consumers, corporates, they also have room to raise prices in an inflationary environment, which would benefit their margins and also their earnings. So this has led the BOJ to grow increasingly confident that Japan has actually embarked on a virtuous wage price spiral that is capable of sustaining a 2% inflation target. So rising inflation in Japan, it also has other factors, other positive benefits, such as motivating investors to explore riskier investments, such as your equities, for instance, in order to protect their asset values. And because of that, many investors in Japan, they have been channeling their funds into the equity markets, and this also supports equity prices in the process. So Japan's strong stock market performance after decades of very mediocre returns, it also provides a compelling incentive for domestic investors to start investing. Now, besides the resurgence of inflation, other reasons why we like Japan include its corporate governance reforms, and that is mainly driven by the Tokyo Stock Exchange's call for companies to disclose plans to improve their capital efficiency. And with robust future earnings and price hikes and increased consumption, we think that companies, they are poised to continue the trend of share buybacks and also dividend hikes, which would benefit investors. So finally, Japan's efforts to reclaim its lost status as a semiconductor powerhouse could also serve to help reposition the economy towards a positive growth cycle. So its expertise in advanced manufacturing becomes a leverage as global chip companies are starting to diversify their supply chain amid rising US-China tensions. So a few examples. So for instance, Japan has actually announced plans to provide TSMC, which is the world's largest chip maker, with up to around 730 billion yen worth in subsidies to support the construction of a second chip fabrication plant that will provide chips for AI as well as autonomous driving. And likewise, aside from TSMC, other chip giants from other countries like Samsung and also Micron, both these companies, they have also planned massive investments in the country. And of course, this is supported by subsidies from the Japanese government. So all in all, with regards to Japan, we do believe that investors, they should embrace the BOJ's policy pivot, as it is a sign that the country's woes with deflation, it is finally over. And Japan's growth narrative, it is ultimately driven by structural factors rather than cyclical ones, which presents an attractive long-term investment opportunity. So in a nutshell, these are the reasons why we like Japan and why we intend to maintain our overweight position in Japan. And yeah, aside from Japan, the US is also another important market that we need to pay attention to, especially with the recent changes on the monetary policy front. So the US economy, just a little background, it has held up surprisingly well, even in the face of elevated interest rates. So according to the third and final estimate of GDP released by the Bureau of Economic Analysis, real GDP in the US increased at an annual rate of 3.4% in the final quarter of last year, following a gain of 4.9% in the third quarter. So growth in the fourth quarter, it is mainly driven by increases in consumer spending during the holiday season. And for the full year of 2023, GDP rose by 2.5% versus a gain of 1.9% the year before. And looking forward, markets, they seem to have fully embraced the soft landing narrative, as economic growth estimates for 2024 was actually revised up from approximately 1.2% as of late last year to around 2.2% today. And even Fed officials, they appear to share the same optimistic sentiment, as they have also raised their forecast for GDP growth from 1.4% to about 2.1% in the latest summary of economic projections that was published after the March meeting. So with such robust growth and inflation, it remains elevated in the US. And as a matter of fact, if you look at the chart on the right, you can see that US inflation has actually come in above estimates for the past 4 consecutive months, with the latest reading coming in at 3.5% year over year for March, which is above estimates for a 3.4% gain. So similar to Japan, one of the reasons for this hotter than expected inflation in the US is because of tight labor markets. So if you look at the US economy, it added close to 300,000 jobs in the month of March, beating estimates of, I think, 210,000. And in other measures, there are also approximately 1.4 job vacancies for each unemployed worker in the US. So I think it's safe to say that even after so long, the US labor market, it remains tight. So another point on that is that US consumers, they are also less affected by higher interest rates, which also leaves them with more cash to spend, thereby fueling inflation. So on this point, I'd like to share that for the US consumers, it's vastly different from the rest of the world because of reforms to the housing market after the 2008 global financial crisis. So prior to the 2008 global financial crisis, actually, most of the consumers, they actually took out adjustable rate mortgages. And because of that, they tend to be more sensitive to interest rates. Makes sense, because when interest rates rise, your adjustable mortgages, the rate you pay will go up as well. But fast forward to today, because of reforms in the housing market, the majority of US consumers, they actually hold a 30-year fixed rate mortgage. So it is estimated that more than 90% of new mortgage originations today are on fixed rate loans rather than adjustable rates. So that also it means that when the Fed raises rates, consumers, they are less likely to be affected. So fixed rate loans in the US, it is a little bit different from what we have here in Singapore. So so in the US, a fixed rate loan, a 30-year fixed rate loan, it really means a 30-year fixed rate loan. So for instance, if you lock in the loan at 2.5% interest rate for 30 years, that is the rate you pay for 30 years. It's not like Singapore where our banks offer fixed rate, but it's only fixed for the first 3 to 5 years. And after that, it adjusts to a board rate, or rather the prevailing interest rate. So because of that, US consumers, they are less sensitive to changes in interest rates, which leaves them with more cash to spend and thus fueling inflation. So another reason why inflation is so hot in the US is also because of rising tensions in the Middle East, especially now with Iran getting directly involved in the conflict. So oil prices, they are likely to remain elevated, and that should also play a role in driving inflation higher. So with regards to the conflict in the Middle East, we see 2 risks here. So the first is risk of a broader conflict, especially as the Middle East as a whole, it is estimated to account for roughly 1/3 of the global oil production. And should other countries in the region also start taking sides, I think the energy supply picture, it will look increasingly precarious. So the second is the risk of transit disruption. So the Strait of Hormuz sees almost 20% of the global oil supply and it's a significant amount of all shipping volumes. And the thing is, Iran's geographical proximity to the channel also means that there is a risk that supply may be disrupted. Now, higher inflation readings, they have already had an impact on markets, especially in the recent times. So for starters, it has, number one, prompted the Fed to reevaluate its rate cut trajectory. So I think just a couple of days ago, Fed Chair Jerome Powell has even said that the recent data has clearly not given us greater confidence and instead indicate that it is likely to take longer than expected to achieve that confidence and for inflation to go back to 2%. And on top of that, he also signaled that the Fed would not be cutting rates until they are absolutely certain that inflation was on a steady path back to its 2% annual target. And not just the Fed, but investors themselves, they have also adjusted their expectations from 6 rate cuts at the end of last year to roughly 3 rate cuts a month ago. And if you look at the numbers today, based on the interest rate futures pricing, the investors are actually only anticipating 1 rate cut this year. And the 10-year Treasury yield has also risen from 4.2% at the start of the month to about 4.6% today. And that reflects the market's expectation for higher for longer interest rates. So the recent data on inflation and interest rates on the US, it only serves to reinforce our view that rate cuts are unlikely this year. And that is actually something that we have been calling since late last year when we published our 2024 investment outlook. So ultimately, I think the thinking is cutting rates at a time where the US economy is doing well. It really risks stoking inflationary pressures, which I think is the last thing that the Fed wants to do now. So given that inflation is looking bumpy and looking to reaccelerate, we think that the Fed will likely keep rates higher for longer, or in the worst case, the Fed might continue raising rates again. So with this in mind, we will continue to overweight short duration bonds versus longer duration bonds. So long-term bond yields, they are still not attractive enough for us to take a position from it. And we also think that yields, they have room to rise from here on out. Short duration bonds, on the other hand, they have been providing attractive yields with minimal duration risk. And that is where we're happy to be right now. So for equities, we also see the need to be selective as we plan to focus our exposure mainly on higher quality companies, meaning companies that have strong balance sheets, resilient earnings, margins, and preferably ones with competitive advantages. So basically, companies that have all the tools you need to survive if interest rates stay higher for longer. So on that end, the quality factor, it is something that we are paying very close attention to. So yeah, I think that sums up our market outlook on Japan and the US. I think these are the two major markets that have the most happening developments in the past few weeks. And yeah, with that, this sums up our webinar today. And before I end, I just want to share that the team is currently in the midst of making some changes to our neutral allocation for equities. So some of you may know that for the longest time, FSM Managed Portfolios, we have followed a GDP weighted methodology. And I think things are going to change from here on out. So discussions are still in the early stage, so I'm not able to share the details. But broadly speaking, we would likely see further reduction in Chinese equity exposure, which again is a market that we are negative on, structurally negative on, while increasing our allocation to developed markets such as the US. And I think we should be able to get this done soon, and I will share more details with you guys in the next update. Yeah, so yeah, come to the end of my sharing today. So if you have any questions, please feel free to use the Q&A function. I'll be happy to take them. Thank you.
All right, thank you, 𝗪𝘀, for the wonderful sharing and also sharing with us, some exciting news that we can look forward towards our map. So I'm opening up the floor for questions. So feel free to use the Q&A box, to ask us any question that you have, be regards to how the markets will react from here, be on Fed rate cuts, and then things about the US markets and then the Japan market moving forward. So I will open up the floor. Feel free to use the Q&A box. Right. So we have a question. Sachin, do you want to take on the question?
Yeah, so we have a couple of questions on China. So the first one is considering that China's stocks are highly undervalued and the government trying to boost the investments. How does this affect China's prospects in the mid to long term? So I think there has been quite some developments in the Chinese market lately. I think if you've been paying attention, the market has actually been on a rally with a number of Chinese-focused benchmarks actually surging into a bull market, rising more than 20% from their lows. So the current sentiment also marks a sharp turnaround from just a couple of months ago when China is actually one of the worst performing equity markets across the lot. And I think you're right, the rally has been fueled by increases in share purchases by state funds, curbs on short selling, and also positive economic data with recent purchasing, the PMI index coming in hotter than expected. But I think ultimately China's issues are mainly structural, and what the government is trying to do is basically throwing money to support investments, support the market directly, and that is something that is unsustainable in the long run. So what we view about China is the market needs to see some significant structural reforms before it can see a sustained recovery. I know that Chinese stocks, they are extremely undervalued right now. In fact, if you look at some of the tech stocks, they have fallen half, some more than 3 times from their original price already. And it may be tempting for investors to come in and invest. But our view on China is rooted in structural issues, property crisis, a top-down state-controlled economy, government that actually prioritizes the needs of state-owned companies more than the profitability of private enterprises. I think those are some risks that investors should be wary of. And yeah, I mean, if you think about the crackdown in technology stocks, it has been ongoing for several years already. Share prices are still very low, and I don't think there's any strong catalyst that will see a re-rating in prices right now.
All right. Do you want to take a second question also?
Okay, there's a question on China has been advocating consumerism to stimulate the domestic economy, and is this move gaining traction? I think the short answer to that is the consumers, they don't have confidence to even consume. Right now, most of their money in Chinese citizens, most of their money is actually tied up in the property sector. And with property prices plummeting, I think it's very hard to get people to consume when the prices of your most valued asset is dropping. So I think the short answer to that is, yeah, it's really hard to spend when you just don't even have the confidence or confidence in the economy and that you will do well. So yeah, I think consumerism in China, I think first of all, China has actually needs to solve some of its structural problems first, regain the confidence of its consumers before it can think about using consumption as an engine for growth. Okay, there's a question on the MAPS portfolios underperforming the benchmark. So yeah, I think one of the main reasons is because the benchmark is actually there for it's there for us to the benchmark, it is not accurate. It is not the most accurate measure of our performance because the benchmark that we have been using so far, it is from the MSCI AC World Index. So the MSCI AC World Index is actually a market cap weighted index, whereas our portfolios are actually constructed based on a GDP weighted methodology. So this was done years ago when the portfolios were incepted. But like I mentioned earlier, the reason for doing that is because at the time we thought that China, I think the team thought that China was an up and coming economy and it's likely going to overtake the US at some point, emerging market growth story, so to speak. But now, given that we are structurally negative on China, we are actually looking to make some major changes to our portfolios, which would see a lower allocation to China and higher allocation to developed markets. And I think personally, I feel that once these changes are made, our portfolios will be, the performance would definitely be more in line with with the market cap weighted benchmark. And I think even if you compare with the GDP weighted benchmark, I think our performance is not that bad actually. I think it's pretty comparable as well. Okay, there's a question on India. Given India's stable government and bright outlook, investors have been moving out of China. So does it look like a good place to invest, or is it overpriced already? I think the issue with Indian equities is that historically it has been overvalued. So it's very hard to find a opportunity to enter the Indian markets. And I think the problem with India is also, I know that many companies, they are talking about this China plus one strategy, diversifying outside of China, given the rising geopolitical tensions between China and the US. But India is certainly one of the names that come up, but I think India isn't perhaps the best destination to do so. And I think the reason is because I think India just doesn't have the expertise to do the kind of high level manufacturing that other Asian economies such as Taiwan, South Korea, or even Japan does. I think the countries that I've mentioned earlier, or perhaps even Singapore, it would benefit more from China plus one strategy. Yeah.
This is just most of the questions have been answered. So yeah, I just want to say thank you, Dajin, for the wonderful sharing. And also a big thank you to everyone here, who is with us this evening. I hope you find the sharing useful in your investment journey in 2024. And also lastly, we would like to invite everyone here to connect with us. So on the screens, again, are the links to our various social channels. Feel free to scan the QR code of the channels that you use often, and we will see you there. And so with that, the webinar has ended, and have a great evening, everybody. So feel free to exit if you need to. Thank you very much, everybody.